stock market and the big companies, through to the backbone of New Zealand, which is well said as being the one-man bands and the small and medium-sized enterprises. Their needs and what they want are quite different. And there's been a lot of regulatory weight and tape being put on business, and a more flexible approach would certainly be helpful. But I think that this Labour government is probably not going to help alleviate some of those things, because it is fundamentally finds that trickier.
It wants to create jobs though, and it is difficult to identify how to do that if you're not talking to the people that will employ people.
It's not knowing what to do it, it's what not to do. And so things like the challenges of increasing minimum wage is a real impediment to taking on new jobs. There is not the minimum wage has gone up 20% in the last 3 years. There is no business in New Zealand that's had revenue growth of 20%, and so expecting the owner to always be the person who takes less of a business when they're taking all the risk is probably not the right balance.
Well, what you're talking about is priorities. Certainly the priorities probably for this government is going to be, and for the Reserve Bank, and you've got to remember that the Reserve Bank from a market's perspective is actually very important as well. The main priority is going to be employment, getting people kind of employed, getting a decent income, and once they've got a decent income, spending it in an appropriate way that brings everybody out of poverty. The shock has been so great that monetary policy can't do it alone, and that's been well recognised, I think, by Grant Robertson as well, who quite early on in the piece has been progressively rolling out fiscal support. You will be, there are other things the Reserve Bank can do other than interest rates, but the Reserve Bank of New Zealand certainly wants to be in a position whereby they can sleep soundly at night and saying that we did everything in our power to actually engender a recovery or to soften the blow of the recession. And that's exactly what they're doing. In the old cliche, they're going early and going hard, and it wouldn't be at all surprising rather than just going modestly into negative territory come March, April next year, or indeed earlier, that they go to kind of negative 50 on the cash rate. After that, there are some extra things they can do, but they'll be wanting that government spending to kind of come through and giving them a hand, or giving the economy a hand to recover.
Tax and welfare doesn't really help fix the problem. It might be a band-aid in a short term. Putting taxes up doesn't actually create anything. If somebody else pays a bit more tax, then that means that they're going to spend less, and whether that means they're not going to have a gardener or not have a cleaner or give less to charity, they're just going to spend less and somebody else spends more. It doesn't actually change the size of the pie, it just gets to change who's spending it. So the only way we can actually improve the situation is to actually increase the pie, and that means lifting everything, not just having an argument over how we're going to slice it.
I mean, property is fascinating because it's captured by people who are stuck in New Zealand, people who are returning to New Zealand, people who now realise that how they work and live will need to be different. So there's multiple drivers supported by these interest rates and the lack of other desirable options. And I think actually importantly, the bank's lending practice is really supportive.
Per head of population, New Zealand has seen the most amount of debt issued by the government, and it's also probably seen the most amount of fiscal spend per head of population just about anywhere in the world. So, to my mind, it's not surprising that our New Zealand equity market is on a bull run, and it's not surprising at all that New Zealand property market, be it residential or commercial, are pretty much at all-time highs as well. And if you go along to art auctions, they're booming. You go along to any kind of asset that you want to kind of look at, it's basically at all-time highs, and that's because interest rates are at all-time lows and likely to go lower. Not only likely to go lower, but stay low for quite some time. And so you've seen a big elevation in asset prices right across the board, and an expectation that they're not going to, well, it's hard to see the catalyst which is going to kind of pop that bubble at the moment. You've also seen, with interest rates being so low, that people that have traditionally put their money in the bank are now facing very low deposit rates, and so are looking for any form of return they can get. And so we've seen a bigger flow into domestic equities, especially equities which in companies which are paying quite high dividends in a sustainable way. And also, Stu talked about residential property. Residential property rents are still around, depending on which part of the country you're in, between about 2 and 4 or 5%, compared to, which historically has been quite low, but compared to money in the bank is now actually quite high. And so, it's not surprising at all to us that we've seen record asset prices over this last 6 months.